Let's get on to the next 600th point with Michelle Schneider, Managing Director of the Market Gauge Group. $250 million in assets under management. We always love having your voice, Michelle. Talk to us about, well, Twitter to one side. Let's talk about the rest of the market and actually the desire for the market to be risk on today. It would seem once again, even though geopolitics wouldn't point us that direction, let alone, well, some of the earnings numbers.
Well, certainly we have a market that has seen a series of incredibly almost religious experience type bear market rallies. And so a few weeks ago, we had talked about this 6 to 7 year business cycle, particularly that held up in the Russell 2000, the transportation sector and the retail. And that was when we saw the nadir in the markets, that it really had proven that even though it seemed like the market was going to go much lower, at that point there was support coming in at this sort of low of this bullish business cycle. And here we are now testing another major area of resistance in a lot of these sectors, particularly in the Russell index at the 200-week moving average. So this is a range that we sort of expected. So the question is, what happens from here? And that's where we can really not only look at the charts, but we can step back now and think a little bit about some of the macro things that we're seeing. One is bad news being good news. Oh, that's it. Fed's going to pivot. We don't have no proof of that. Two is the dollar, which was a big flight to safety, has relaxed a lot. And three, of course, is going to be what happens on the heels of the earnings. But if we're just looking in terms of the momentum right now, anything that even marginally beats the poor expectations has been perceived as a positive. But we also have GDP coming up this week, so that'll be interesting.
Talk to us about some of the quarterly results as well. You talked about low expectations. If you set them low enough, you're bound to beat them. But overall, what is your feeling about companies' ability to manage down the income statement?
Well, one of the things that I saw today was that there's still a tremendous amount of buybacks by some of these corporations, a lot of them actually, which I was actually sort of surprised to see. But I think that we haven't really necessarily seen the reality fully set in. And this bear market rally is on the basis of the fact that people believe that even though guidance has been suggested as better in some areas, worse in others, that it really all goes back to the Federal Reserve and following the heels of what Japan did and what England did, and now China trying to support their currency, that the Fed is actually going to also involve themselves in some stock and bond buyback. So this is a perception that I don't think is right. So the earnings are almost lagging at this point as opposed to leading.
Well, talk a little bit here about the potential Treasury buybacks, because there's a lot of market chatter right now, not only about the possibility that that's going to happen, but the size and scope of just how much this is actually going to impact the market out there.
Well, here's where I think the Federal Reserve has to be incredibly cautious, because if they actually do go ahead and do something like that and do any type of form of quantitative easing, we can call it that as opposed to QT, and the dollar, which obviously now is back down to a very key support level here at around 111, continues to fall further, what's going to happen, Romaine? We're going to see inflation, which is now all of a sudden on the back burner, come really back into vogue. And that's why in this rally we are seeing precious metals catch up, and even though oil has come off in energy, they're still really, really high. Food commodities today, if you look at corn, is starting to rally again. So the market's sensing that the Fed can actually make a really terrible mistake here and try to goose something before they really say they were going to initially. Which, of course, and one last thing I'll say about that is the perception of the Fed losing control is actually in some ways worse than the reality if they wind up doing that.
Not to mention, of course, a lot of other central banks that have to follow suit in terms of taming inflation. Michelle, your perspective, therefore, on where you allocate in this market when you are still worried about a Fed mistake, when we are still on the precipice of a recession?
Well, we still like really much the energy place. Today, a lot of our quantitative models bought a few energy stocks, which seem like they're highly elevated in terms of price. But clearly the quant models, which measure trend strength indicators, think they're going higher. Personally, I really like precious metals here. I think in particular the gold looks like it might be trying to double bottom. And then I'm also looking at some other areas like government-backed type of instruments. Like when I say that, I don't don't mean they're buying the instrument, but they're contracting with that particular company. A company like, for example, Palantir or General Electric, which just reported earnings. We're also looking a little bit here in terms of maybe some type of reindustrialization. Another place where the government is putting money, obviously, is in the EV space. So we're watching all of this, but we're still pretty much in cash. We want to see more proof before we start piling in.
Yeah, that seems to be the mantra from a lot of folks out there. Michelle, great to catch up with you. Michelle Schneider, Managing Director over at the Market Gauge Group, helps